Okay, then let's solve these questions one by one.
So,
First one, always keep the answers also handy with you, okay, in case if you
yeah,
go wrong. First we will try, okay.
yeah,
You can see the screen, right? Okay. The Standard and Poor's depository receipts spider. So this is a depository receipts index, okay, which is
okay,
called as spider. Is an investment is an investment that tracks S&P stock market index. Okay, S&P stock purchase and sales of spider uh, is an investment that tracks S&P 500 stock market index. Purchase and sales of spider during an average trading day are best described as purchase and during an average trading day. Primary market transactions, secondary market in a pooled investments in an actively managed investments. See, A will not come. Why A will not come? Because primary market refers to new issue of
yeah,
securities,
yeah,
whereas here purchase and sale of spider during an average trading day. That means they are buying and selling as usual normally.
right,
Okay. So A you can eliminate primary market. Now secondary market transactions in your pooled investments and then in an actively managed investments. Now pooled investments, why? Because uh, it is an index. So you are buying an index here, S&P 500 index. So you are buying all the depository receipts into that in that index. Okay,
okay.
it should be B. Is it B?
Yeah, like yeah, it's
It will
B.
be right.
I
Okay.
went for C.
Huh. Now, actively managed investment is when you are picking on your own whatever you want. Here, that is not the case. You are investing in all the deposit receipts within this S&P 500.
Okay,
That is the reason. And also, this spider is an investment. See, this is depository receipts investment. That means they are pooling money from the public and then they are investing.
okay.
Okay.
Uh,
Yeah.
And the 12th one.
The usefulness of your forward contract is limited. Forward contract, you leave it. Okay. This is derivative contract.
So
Ah,
I have a doubt like in forward contract, there's a counterparty risk. So which means like one party can they can just get out of the contract, right?
no,
So
no, they cannot get out of the contract. It's an obligation for both.
it is during futures, right? That
Options, you see, forward and futures both have obligations.
okay.
Okay, see, Shravani, you will get many, in the curriculum, you will get many derivatives questions also. Somehow they have mixed it up. So if you find
Yeah,
derivative
there are
questions, you
many.
can ignore. Yeah. Whenever
There
you
are
find
many.
derivative questions, you just ignore it. Okay. Because why? Because once we finish derivatives, that time you come and see these questions, it will be easy for you. Okay.
Okay.
Then yeah, uh,
And 14th one.
this is
I
also
didn't get it.
hedging. This is derivatives only.
Uh,
This is derivatives. Hedging is
right.
all derivatives. Forward again. See, this forward, future, all these are derivatives. Then, this is an exchange traded fund. Okay,
Yeah.
it is an exchange traded fund ETF in the US that is designed to track S&P 500 market index. Okay, the latest price of a share is 290. Achha, this is also call option derivatives only. Okay, all are derivatives only.
Hmm.
Okay,
So we're not
that's it.
doing it right now.
Yeah, derivatives will not do now because
Okay.
you will, then that will take me to derivatives topic. That
Right.
many doubts only you had.
Yeah, like I'm yet to do all these sums. Like
So
I'm currently
derivatives we can
rethinking.
ignore right now
Yeah.
because after this subject, when we finish derivatives, that time we will come here.
Okay.
Okay, even after this subject, we can do derivatives then.
Okay. Yeah.
Okay, then it is fine only then otherwise. So we'll start then. Okay, so yeah. Huh. Okay, so till here we did right. So we are supposed to begin from here. LOS42.h. Compare a company's cost of equity. Acha, here, this is a very simple sum only. Return on equity. I'll directly come to the question. See, example, return on equity, market and book value of equity calculations. Given the following data for O grade industries, calculate the return on average equity for 2009 and the total market value of equity, the book value per share and the price to book ratio at the end of 2009. Fiscal year end December 31st. Okay, total shareholders equity, net income available to common, stock price, shares outstanding. So question, first of all, return on equity we have to find out. See, return on equity formula is return means net income divided by equity. Equity is average equity. Okay, average equity. So how do I calculate now? Return on equity. See here, net income is given and equity is given. Okay, now when they say average equity means I am supposed to take the average value of this equity. So average of equity is 17,143 plus 18,503 divided by 2. So 17,143 plus 18,503 divided by 2. Net income is 3526. Okay, just calculate this into 100. You can do return on equity to convert it into percentage.
It's 19.783.
Okay, so 19.78 percentage. Okay, this is matching. Yeah. So what does this mean? What is the interpretation? Interpretation is if you have 100 rupees in your hand, you are creating net profit of how much? 19.78. With 100 rupees, you are creating net profit of 19.78. That's what it means, return on equity. Okay. The next one is market and book value of equity. So market means market value. Market value and book value. So market value to equity. Market value, how will I know? Market value means market value is also called market capitalization. Remember we did market capitalization. What is the formula? Do you people remember? Number of shares into price per share,
Price per
market
share.
capitalization.
Number of shares
So
outstanding.
yeah, number of shares outstanding into price per share. So number of shares outstanding is here 3710. Price per share
Right.
is 16.80. So
Right.
3710.16.80. 3710 into 16.80. This is market value
It's
to equity.
60.
Equity is market value to equity. So equity, I'll go with average equity again. Okay. Uh, Acha, only market value to, okay, it's not market value to equity, only market value they have asked. Market value and book value. Okay, it's not market value to average equity, only market value. So that means market capitalization. Just calculate this.
It's 62,328. 328.
So yeah, 62,328. This is market value. Then book value. Okay, book value is how much? Book value is also called shareholders equity. Both are same only. Okay, book value is also called shareholders equity. So okay, now book value is equal to, it is the same number 18,503 I can also calculate book value per share. Per share means 18503 divided by number of shares,
31371.
3710. Okay, just calculate this.
It's 4.98, so then 5, right?
4.9875.
773.
Okay, so book value per share 4.99. Okay,
That's it.
fine. Book value per share 4.99. Okay,
Yeah,
then price to book ratio. Price to
price.
book is not asked here, but okay, here it is asked. Market value of equity, book value per share, total market value. Okay, here is the question properly mentioned here. And price to book ratio. Price to book means price to book value per share only. Why book value per share I'm taking? Why not book full? Because price per share I'm finding. See here, price per share is mentioned 16.80. So because it is 16.80 per share, my book value should also be per share. So per share I have already calculated here. Just calculate this.
16. It's 3.3667.
So 3.36. Okay. So
Price
3.37.
to
That
book
is fine.
value. Okay.
Okay. So what is the interpretation of all these things? The interpretation of all these things is uh, the interpretation of all these things is book value per share means uh, see, basically what do you mean by book value per share? What do you mean by market capitalization? Market capitalization means the value valued by the market. That means at what price market has valued per share. That's what you get to know in market value or market capitalization. Book value per share is book value per share is uh, see what is the purpose of book value? The purpose of book value is, see, now this is the company. Now in this company there is balance sheet. In the balance sheet, this side is all assets, this side is all liability. Now assets are there. Now liabilities, imagine it has equity, then retained earnings, and then other debt and other things. Okay, short-term debt, current liability, and all that. So this part is called as shareholders' equity, which is also called as book value. Book value I can even calculate as assets minus outside liabilities. What do you mean by this? Assets minus outside liabilities. That means if imagine uh, asset is 1,000 and liability is let's say 600. So remaining this part, equity and retained earnings, will come to 400. So this 400 is called book value. Okay, why? Because the understanding is, even if the company goes bankrupt today, the assets of the company will be sold, they will get 1,000, and then it will be paid to all the debt holders 600 rupees, and remaining 400 will go to the equity holders. That is called book value. This is the actual net worth of the company, 400. Now this 400, imagine you are one of the shareholder, you would like to know how much will you get. So that's why we need to calculate book value per share. Okay, so like here per share is 4.99. So what is the interpretation? That means if book value, when it is 1 rupee in the market, okay, book value per share means, acha, for per share, not 1 rupee in the market, it is when it is 1 rupee, sorry, when for per share, its value is 4.99. That means if you are holding one share, you will get 4.99 if it goes bankrupt. You understood the meaning of this ratio? Book value per share means per share, if you are holding, its value is 4.99 in the book, in the balance sheet. So that means if theoretically if this company goes bankrupt, you will get 4.99 rupees for holding one share. Book value per share. So higher it is better. Are you both clear with this one?
Yes, sir.
Okay.
Yes.
Now price to book value is what? Price to book value is 3.36. That means if book value is 1 rupee, okay, here this one is for one share, how much money you will get. Now if you are getting 1 rupee, for that how much the market is willing to pay? Market is willing to pay 3.36 rupees. So normally price to book value per share will be higher than 1. If it is lower than 1, it is a highly undervalued stock. Okay, highly undervalued stock. Okay, fine till here.
Yes.
Okay. Cost of equity means what, remember we did CAPM last time. CAPM is also what? Cost of equity. CAPM is one way to find out cost of equity. That means if your company is using your equity, what is the cost that they are supposed to pay? Because you will have some expectation from the company, correct? You will have some expectations, no? That the company, should give me at least 13% return, 15% return. So whatever you are expecting, that much the company is supposed to live up to it. Okay, so that's why that becomes the cost of equity. Now reading 43 company analysis, past and present. Uh, See, these all are very easy one and self-reading one only. Okay, so I'm just skipping this part, but when you read, it will be very very easy one to understand. Okay, but and you should read this. These are all good one. This is a good one to read. You will get some good information. Okay. Business model also, you should read this part also. You should read. It's a good one again, but self-reading all. Okay. Revenue driver, all these are good one to read. Like what will drive revenue? So these are all like the qualitative factors that you should be aware. Like uh, what will drive revenue, what will drive the pricing power. Okay, that means it will tell you how good the company's products are. Okay, how much power do they have, whether company, say for example, pricing power. Imagine the product that the company is selling, people do not have any choice, they have to use it. Say for example, internet. So then that means the pricing power is very good for the company, and pricing power is very good for the company. Okay, now instead imagine another case. If DMart is increasing the price, you will immediately go to another shop. Then there the pricing power is very low. Okay, low cost producer. One notable exception is a low cost producer. Okay, zero economic profit. In the long run, price taker. Price. This is part of economics. Now they have added here. In the long run, price taker markets usually result in returns being close to the cost of capital, so there is zero economic profit. One notable exception is low cost producer. What does this mean? Price taker market. Price taker market means perfect competition. You must have heard in economics, right? Perfect competition. Okay, perfect competition. Have you heard perfect competition?
Yeah, where all the products are like homogeneous and
Yeah,
all.
correct.
Right?
So
Okay, yeah.
perfect competition means, just example like what you see outside a railway station. Similar products will be sold almost all everything at the same price. That is an example of
Right.
perfect competition. Okay. So easy entry, easy exit. So in that case, they do not make abnormal profit. They just make very normal profit. Zero economic profit means no abnormal profit. That means they just get paid for their labor charges, because they are standing there for 10 hours, 12 hours. Whatever amount they should earn, only that much they are earning. Nothing beyond that one. So that is a price taker market. Price taker means they cannot put their own price in it. Why? Because the moment they increase the price, nobody will come to them. Okay, because there are other competitors in the market ready to sell at the lower price, right? That's why. One notable exception is low cost producer. Somebody who is producing, now here we are, somebody who is producing at a very low price, probably that person may make profit. Okay, then commoditization. What do you mean by this commoditization? Describes an industry that is evolving towards this state as more participants enter. Commoditizing means basically something which anybody can produce. That is called commoditizing. Okay, so that means there is no speciality. There is nothing like, only this company has the ability to produce. There is no nothing special about the company. Anybody can do that kind of thing. Like for example, if I open one, like vada pav shop outside your college, and I'm making profit, but then it's a commoditized business. That means what? That means anybody can make. So the moment I make extraordinary profit, what will happen? Somebody else will come and copy that idea, and they will immediately start making. That is called commoditized business. Okay. Then market size means how big the market is, and within that, what is the market share of this particular any particular company. Say for example, market share. This is $1 billion company. Anything. Take one example like example cloth textile is $1 billion company, out of which this particular XYZ company might have 10% share. Okay, again all these are very basic stuff only, and this one I need to explain this equation. Okay, this is called operating leverage. Operating leverage. So operating leverage means what? Operating leverage, the degree of operating leverage. See, for example, let's say, see, normally, you know, uh, if I have to calculate net profit using functional classification, then how will I calculate? It will be like this. The format is like this: revenue, revenue or sales minus cost of goods sold, gross profit minus sales general and administration, then EBITDA minus depreciation, then EBIT minus interest, earning before tax minus tax, earning after tax. Okay, earning after tax is also called as net income, then net profit, and then also called as profit after tax. Okay, this is functional classification. Okay, for income statement. Now there is another one, behavioral classification. Behavioral classification is sales or revenue, okay, minus variable cost. Then sales minus variable cost will give you contribution, then minus fixed cost. Okay, then that will give you EBITDA. No, not EBITDA, EBIT. Okay, EBIT, this part. So EBIT here. Further also there are, but let's stick to this much at the moment, and then in few minutes I will continue this further. See, let's say sales is 1,000. Imagine variable cost is 50%. Variable cost means what? That you will incur only when you are selling the product. Example, you are into coffee business, so you will incur expenditure of sugar and milk only when there is an order, right? Otherwise you don't have to spend. So imagine this is 50%, so this will come to 500. Contribution means sales minus variable cost is contribution, 500. Now fixed cost is, imagine, 250. So what is EBIT? 250. Okay. Now let's say if this sales increases by 10 percentage, then this becomes 1100, and this 500, this is 50 percentage, right? So it will be 550. So contribution is 550. Fixed cost will remain fixed. So this is how much? 300. So now you see how much is the profit going up? 50. So that means 50 divided by 250 into 100. Just calculate this, how much?
20%.
20 percentage. So 20. So that means, see, 10 percentage only profit went up. Sales went up by 20 percentage. See the difference. Why is this happening? It should be going up only 10 percentage, no? Why so? That is because, see here, um, here, contribution did not go up. Here it is 50 percentage. Okay, 50 percentage. Here also it is 50 percentage only. But then EBIT has gone up, because when uh, when this contribution here, it has gone up, proportionately fixed cost is not going up. Because fixed cost is not going up, that means your operational fixed cost is constant, because of which I am getting this leverage. So this is called as degree of operational leverage. Degree of operational leverage. Okay, degree of operational leverage. Okay, and this degree of operational leverage, uh, yeah, now degree of operational leverage. So how do I convert this into a formula? So degree of operational leverage is equal to percentage change in EBIT based on percentage change in what? In sales or revenue. So what is the percentage change in EBIT? 20 percentage, right? And for 10 percentage change in sales, that is equal to 2. Now there is one more formula also. One more formula is contribution. This is for base case scenario. Base case means, suppose if this part is not given, this second next year's data is not given. Assume you have only base year data. Then contribution divided by EBIT. You can calculate like this also. Contribution is 500 divided by EBIT is 250 equal to 2. Okay, these are the two formulas. Now further let's see. Next one is degree of financial leverage. Let's see that one. Now EBIT, after EBIT, let's say minus interest. This interest is, imagine, 125 rupees. So it will be earning before tax, which will be what? Again 125 rupees. Now imagine tax is 50 percentage. So what is 50 percentage of 125? I think 62.5, correct? 62.5, no? Yeah. So 62.5, this is net income. Now suppose, now here you see, interest is 125. Now when I get 300 profit, still my interest will remain the same, 125. So what will be my earning before tax? It will be 175. Okay, and what is 50 percentage of this? Calculate 175 into 50 percentage.
87.5.
87.5.
Yeah.
So this will be 87.5 net income. So now you see, when EBIT went up by 20 percentage, let's see what happens over here to net income. Just take the difference.
87.5.
Uh-huh.
25.
So 25 is the difference, right? Divided by
uh,
62.5 into 100.
Divided by 6. 40%.
14 percentage.
No, 40. Sorry.
40.
Yeah.
So you see, EBIT went by 20 percentage, net income is going up by 40 percentage, double. Okay, so how do I put this into formula? So why is this happening? Reason being because of this interest. Now interest is fixed. So when the revenue profit is going up, interest is limited. It is that much only. It is not going up, which is good for the
Yes.
company. So the company's profit is jumping up highly.
This is DFL, right? Degree of
Yeah,
financial.
this is called degree of financial leverage. The formula is percentage change in this is net income, right? So earning after tax based on net income or earning after tax. Okay, based on percentage change in EBIT. Okay, so percentage change in earning after tax is what, 40 percentage, and EBIT is 20 percentage. That is equal to 2. So this, so initially this was also 2 degree of operating leverage. Now this is also 2 degree of financial leverage. This is degree of operating leverage, degree of financial leverage. Okay, now for base case scenario, or there is one more formula here, that is EBT, earning before tax, divided by this and this, earning before tax divided by earning after tax. So before tax is what, 125, earning after tax is 62.5, so that is equal to 2. Okay, this way you can do. Now there is one more also, degree of total leverage. Degree of total leverage means basically what you want to find out is what is the change in net income based on the change in revenue itself. Okay, when sales is changing, how much is profit going up, net profit going up? So it will be percentage change in earning after tax based on percentage change in uh, sales. So what is the percentage change in earning after tax? 40 percentage. Sales is 10 percentage. So it is 4. That means for every 1 rupee, 1 percentage change in sales, 4 percentage change is happening in sales. This is total leverage. So which is extremely good for the company, right? Slight increase in sales is making a huge increase in earning after tax. Now there are other formulas also for this. We can say degree of operating leverage into degree of financial leverage. This will also give you 2 into 2 equal to
This
4.
is called combined leverage, right?
No, in CFA we say degree of total leverage only.
Okay.
Then now degree of operating leverage, we can use this base case also to reframe the formula. Contribution by EBIT into uh, sorry, this formula is wrong. This formula is wrong. This is not EBT by EAT. It is EBIT, earning before interest tax, divided by EBT. So earning before interest Yeah, sorry. This is 250 divided by 125, that is equal to 2. Okay. So sorry. So here EBIT, okay, this is degree of financial leverage and this is degree of operating leverage divided by EBT. So this gets cancelled. So contribution is how much? Contribution is 500 divided by, or I can write the formula as contribution divided by earning before tax. So contribution is 500, earning before tax is 125. So 500 divided by 125, just calculate, it will come to 4, which we got here as well and here as well. So many formulas. Okay, this is one formula, second formula, third formula for degree of total leverage. This is okay?
Yes.
Yes, sir.
Yeah. Okay. Yeah. See, now what kind of companies, practically, uh, okay, practically, uh, when you are researching, what kind of companies will have this high degree of leverage? See, this degree of leverage has a side effect also. So this is extremely good to see that, sales are going up and net profits are going up. But what is the side effect? Side effect is, what if sales are coming down? So imagine 10 percentage coming down minus, then what will happen? This will become 900. Okay, then variable cost is 50 percentage, 450. Then contribution will be 450. Fixed cost will still remain fixed, and EBIT will become 200. Then interest will be 125, you still have to pay, and earning before tax will be 175, and tax you have to pay 75 is half you take, is 37.5. So now your profit has become 37.5 from 62.5. So you will realize that 10 percentage reduction in sales is also reducing the net profit by 40 percentage. Just check the difference, 37.5 minus 62.5. How much? 62.5 minus 37.5.
60. So it's 66.6666.
62.5 minus
That is
37.5.
25. So 25, like you told us to find the percentage, right?
25
Yeah.
is less based on 62.5 into 100.
Okay.
How much?
62.5. It's 40%.
Yeah, minus 40 percentage, because 60/25 has come down. So you see, it is a double-edged sword. If it is giving you extraordinary profit for sales increment, it will give you extraordinary losses also for sales decrease. Okay, so that's why it is a highly leveraged company. So when should you invest? When you believe that the sales will go up, you should enter into such kind of companies. And when you believe that the sales will not go up, you should immediately exit from such kind of companies. Otherwise, you will lose money. Fine, okay.
Yeah, it is.
Yes, sir.
Yeah. Now, what kind of companies are like this, where they're fixed, where their cost is fixed? Any thoughts?
Mm. Banks, like so every company the like for them there'll be fixed costs, right?
Yeah, but then we have to find out those companies which are highly leveraged ones, where the cost is fixed. So when more sales happens for them, it is all direct profit. There is
Okay.
no problem for them. They don't have to spend money on milk, sugar to make additional coffee. When somebody is ordering additional coffee, we have to. If you are in coffee business, every time your variable expense keeps going up, no?
Yes,
So
sir.
fixed cost, example, you just imagine, for example, hotel industry. Now in hotel industry, where in hotel industry where uh, uh, you know uh, fixed building has been set up. Now no matter how many people come there to stay, for the company everything is a profit. So during this October, November, December, January, when people go out, January, February, March, you know when people travel, for hotel industry they make huge profits at that time, right? Hmm.
Yes, sir.
Yeah. Then other companies will be like, you see uh, this water park and all such company, during summer vacations, that time when people go there, again it is fixed cost. Place is already ready. When more and more people
Like
go there and have vacation time in water
uh,
park kingdom and all that thing.
an
So,
asset management company also, right?
ah,
Like
hmm. Now coming to finance companies, example, broking firm. Nowadays everything is working in app, they don't have to do anything. Okay, then
mhm.
only they have to spend money on IT, of course, but then that is comparatively lower in comparison to like whatever hike, more subscription they get. Okay, then other one, like stock exchange, Bombay Stock Exchange, this kind of, or banks also even. When they sell additional home loan, they get huge profits, right?
Yes.
But you should also know, like for example, Bombay Stock Exchange, more and more people, or any broking firm, Motilal Oswal, Financial Services, or Zerodha, or Angel One, and more people are investing, their sales are picking up, and so immediately their profits are picking up. But similarly, when recession comes or market goes down, when people run away from the market, their stock gets beaten badly. Understood why? Because it is highly leveraged. Now, now when people are running away, their profits will also run away very quickly. That is the reason. Have you understood this one?
Yes, sir.
Yeah.
Yes, sir.
Okay. Okay. The next one. Acha, now what is this formula? This is also similar one only. Operating profit means EBIT. Operating profit and EBIT are same. Okay. So here EBIT or operating profit is, they have mentioned Q into P minus VC minus fixed cost. This is fixed cost. So quantity, this is, see, this is like, imagine you are selling coffee 10 rupees. Variable cost may be like 6 rupees. So 4 rupees is your contribution. Okay. Price minus variable cost. And you are selling maybe like, 10,000 10,000 cup quantity in a day. Okay. 10,000. So, and or let's say in a month 10,000 or 1 lakh you are selling, 1 lakh you are selling. Fixed cost is maybe like, just see how much it comes to, 4 lakh. So imagine your fixed cost you are paying 1 lakh, or 50,000 you are paying as rent. Okay, 50,000 is the rent. So this becomes how much? 4 into 1 lakh, 4 lakh minus 50,000, 3 lakh 50,000 is your profit. Have you understood this one? 10 rupees is the price. Variable cost is all that sugar, milk, and all that thing. In a month, you are selling 1 lakh cups, and 50,000 you are paying as rent. So 3 lakh 50,000 is the profit for you, operating profit. Okay. You can,
Yeah.
if you want to do this the way we have done, that also is possible. Our formula is what? Sales or revenue minus variable cost, contribution minus fixed cost will give you EBIT. EBIT is what? EBIT is also called operating profit. So sales will be 10 rupees no, into 1 lakh. So 10 lakh sales. Then variable cost is 6 rupees into 1 lakh. So 6 lakh quantity. So contribution will be 4 lakh. Fixed cost is 50,000. So 3 lakh 50,000. Understood this one? So you don't have to remember this formula as such, just a logical one. But if they give you per unit basis, then you should be able to apply your mind. You can just follow this method itself. If they give you per unit is 10 rupee, per unit variable cost is 6 rupees, then you multiply with quantity and bring it to this format so that you don't have to remember this formula. Is it okay?
Yes.
Yeah. Okay. So this is what this formula all about. They have not given all the formulas here, but it is better for you to remember all the formulas. Okay, you never know. So all this formulas you should know. Here also, this degree of financial leverage, this base formula, base case formula, you should know. Then economies of scale. This is again economics terminology. Economies of scale means, having huge number of volumes of production, huge volumes of production, and thereby decreasing the fixed cost per unit. When increasing cost decreases unit cost, increasing output decreases unit cost. That means you are producing highly with the given plant in the given capacity, so that fixed cost per unit comes down. Okay, it's okay. You understood this term, economies of scale?
Yeah.
Yeah. Then economies of scope occur when adding divisions or product lines results in decreasing unit cost. This can result if multiple divisions or product lines share cost and reduce redundancy, it will reduce. For example, each division would need its own human resource department if it were a standalone company. But as division of a large firm, they can have the same human resource development. So that is economies of scope. Basically, you are reducing the redundancy by combining functions. Okay, here it is degree of financial leverage. Reading 44 industry and competitive analysis. Here, here it is again. This part is good to read. Uh, these are all good to read. So okay, only good to read. A defensive company means what? Defensive company means they produce goods and services for which relatively demand is relatively stable over the business cycle. That means no matter what, such kind of companies will be normal demand will not get affected because of war or anything like that. So examples include health, utilities, telecommunications, consumer staples. These are all defensive companies because whether war is happening or COVID is happening, you are going to, people who needs tablets, they are going to take. Utilities, then telecommunications, internet, consumer staples, food, all these things we are going to use it. So that's why these are examples of defensive company. Cyclical companies means what? Which are in demand in certain time of the year and not in demand for the rest of the year, or they may be in demand once in 3-4 years. That is also possible. They are deeply cyclical stocks. Example, real estate. Example, automobile company. These are all deep cyclical stocks which will be in demand. Railway, defense, these are all deeply cyclical stocks. In 3-4 years it will come into demand, and after that no demand. Okay. ESG. Okay, very important one, ESG, but it is not elaborated anything here. But in other subjects, in between it will keep coming. So wherever you see ESG, I would say like read it, because practically there are many debates happening on this topic, ESG, in the business news channel. Okay. So environmental, social, and governance. That means investors are preferring those companies to invest which is following all these rules. That means they are good for the environment, or at least they are not harming the environment, they are not harming the society, and the governance is good. So what kind of companies are harming the environment? Environment harming companies will be like mining companies, coal companies. Okay, they harm the environment, right? When mining is done. Then social, what kind of companies are harming the society? Example, tobacco company, alcohol companies. These companies, they harm the society. Then governance, where the governance is not good. That means litigations going on, or scam reports going on, or scam fraud reports going on, where our accounting is not done properly. So those are all, the problem. Such kind of companies, these investors will not invest in. Okay, that is ESG. Okay, then here growth companies means nowadays EV stock, electric vehicle, renewable energy. These are all growth stocks. Mature industry means, you know they have little scope to grow. It has grown to the maximum level. Example like example TCS, Infosys, or Hindustan Unilever. So these are all mature industry. Okay, they will grow only at a very slow rate, uh, probably lower than the GDP rate. Okay, then yeah, Porter's five forces. This one is an important one, but easy only. This Porter means Michael Porter. That's his name. Okay, Michael Porter. His five forces. So this is telling you the qualitative factors and quantitative factors. Quantitative factors are numeric one, and qualitative factors which cannot be quantified, but still it is needed. Example, So this is how you can also use this qualitative factors to decide whether you want to invest in a company or not. So rivalry among existing competitors. So you should see before investing in a company, what is the rivalry among existing competitors? Are they are they killing each other to grab the market share, or they are able to thrive on their own? Example, um, okay, example, like you see nowadays this quick commerce company, they all are killing each other. Huge rivalries going on, right? Zomato, Swiggy, Instamart, and that Big Basket, then Zepto. So there is rivalry. So it is difficult, or it is not a good idea to invest in such kind of companies where huge rivalry is going on, because they will keep reducing the price to survive in the market, and that is not good for the investors. Okay. On the contrary, if imagine there is no rivalry, then it is very good. Okay. Then threat of entry. Threat of entry means what? Is there any threat to enter into that sector, or there is no threat? So certain sectors will have entry barriers. Certain sectors there will be no entry barriers. Where there will be no entry barriers, something which is easy business. Easy means, um, let's see some FMCG kind of business. It is easy to enter. Okay. Whereas where there will be barriers to enter, example, where there is monopoly or some government license is required, government license required, or there is what do you say? There is a strong hold of any particular one or two companies. Duopoly is there, or monopoly is there. Uh, like for example, telecom company. Many licenses will be required, so it is not easy to enter into that kind of company, telecom company. Okay, so that will be barriers to enter. Okay. It will be because already monopoly is existing there, or government license is required, or huge capital required. So those are some sort of barriers to entry. Then threat of substitutes. That means if this product, if you increase the this product price of this product, will they go to the substitute or not? Say for example, Coca-Cola and Pepsi, they both act as a substitute, or tea and coffee. So if coffee's price goes up, then people will start taking tea more. So they have substitute. If there is no substitute, then it is good for coffee. Otherwise, coffee cannot keep on increasing the price, because people will go to the substitute, that is tea. Okay. See, in the pharmaceutical industries, patents protect your producer from competition in the market. So here, uh, for patented drugs. So when it is patented drugs, patents protect your producer from competition, because when it is patented drugs, uh, everybody cannot produce. Then only that patented company can produce. So threat of substitutes, other companies will not come on their way. Okay, so then that is a good company to invest in. Then power of buyers. So buyers' ability to bargain for lower prices. Say for example, in quick commerce, people can easily switch. Okay, they have huge power to, power of buyers. They want at the reduced price, or else they will switch. So that is power of buyers. Okay. Then power of suppliers. Power of suppliers. Again, power of supplier means if suppliers are available very less, then they can keep increasing the price. If suppliers are available highly, then they cannot keep increasing the price. Right? That is power of supplier. Okay. So this is also Porter's 5 forces. Easy to understand. But then when you are researching about a company, you should apply all this practically. Then it will make a lot of sense. Then yeah, this all you can read now. These are all some examples. All that stuff are given that you can read later. Similar way only PESTLE. PESTLE also, this is another short form. Okay, PESTLE. So PESTLE stands for, P stands for political influence, whether the company has political influence or not. You may want to check that one. Okay. Uh, so energy, health, care and defense, they have a lot of political influence. Okay, because they need to take a lot of licenses. So you need to know if tomorrow the political scenario changes in the country, whether this company will be able to survive or not. You will have to check. Then E stands for economic influences. Can be cyclical, economic, uh, structural trends such as productivity improvements and the size of the labor force. So economic influences, interest rates affects financing cost. Yeah. So how much it is dependent on the economy, economic influences. Okay. Yeah. So economic influences is all about inflation, interest rates, GDP in the market. How much it will affect that company. Then, so first one is how much politics affects the company. Then economic influences. Then social influences. So social influences, the increased presence of social media and influences have increased the demand for high quality beauty products. So if it is a beauty products, social influences will be there, right? Some companies are going to pressures to use sustainable inputs and to ensure that production processes are ethical and observe human rights. So this is the pressure, social influences. How much social influences happens in that product? Okay. So for the society, whether that product, how much they, how do they look at it? Okay. Then technology influences. So how much technology is needed for that company? Okay. So tomorrow, if technology changes, how much it is going to affect that company? That is technology influences. Then legal influences. So what are the legal charges that are going on against that company? And what if any case goes against that company? Environmental influences such as climate change and concerns about environmental sustainability of some industries. So environmental influences, how much? So environmental influences means, imagine climate change happens. So if climate change happens, will this company be able to survive or not? So environmental influences, this is another way to check a company. Okay. Then next one, yeah, this one, cost leadership also we should know. That is also an important one. After that, let's see how much. Okay, it's over. And here, company analysis forecasting. Okay, I think one or two readings more, and after that, sums all will begin. That will be very interesting. Okay, so cost leadership strategy. Cost leadership strategy. Cost leadership strategy means what? Cost leadership strategy means you are selling your product, you know, with the lowest cost, and that's how you are penetrating into the market. Okay, that is called as cost leadership strategy. Cost leadership strategy example, the way Reliance penetrates into the market. Initially, they keep a very low price. That is cost leader. Reliance products is an example of cost leader. Okay, then differentiation strategy. Differentiation strategy will be example. Differentiation strategies example is iPhone. So iPhone. So it is known for what? Product differentiation. People get different experience when they use iPhone. That is product differentiation. Okay. So claiming that they are giving some different experience, they are penetrating into the market. Focus strategy. Focus strategy means it's a combination of both, like Samsung does. It is in between. Okay, neither too cost effective nor too price differentiation. Something like Samsung. Targeting a niche market. Executing a focus strategy can include aspects of both cost leadership and differentiation as well. Okay, this is all you can ignore. Then company analysis, reading 45 company analysis forecasting. So how to forecast? How to forecast? Now this is also a good one. How to forecast? Just let me see how many are there further. This is 45. Six. Yeah. So after 46 onwards, it is all sums. It will be interesting. 46 onwards. Okay. Shall we take for 15 more minutes then? Uh, okay, or we will stop now there itself. Okay. We'll see then next time, then we'll continue. Okay.
Okay, sir.
We'll stop it there from here. No? So only this reading, after that it will be more interesting. Then. Okay, we'll stop now. No problem. Okay.
Okay,
So
sir.
yeah, we'll stop.
Thank you, sir.
Okay.
Bye. Bye.
Thank you, sir.